Howdy, y'all. Welcome to Liberty Call. Today is Monday, September 11th, 2023. Hope everybody's having a fantastical day out there in the interwebs. It is a chilly day here in Colorado. It is currently right now 55 degrees at my house. Had to turn the heat on today. So it is crazy. So I guess, and according to the forecast, we don't have any more 80-degree days left. Everything is either 60s and 70s for the rest of the month, some 50s like today. So, granted, we'll probably have a warm day here or there occasionally between now and November 1st, but looks like the consistently warm days are behind us. So, which I live here in Colorado without air conditioning, so I kind of welcome the cooler weather. I don't get real excited about shoveling feet of snow, but it's not terrible. It doesn't. This last year was pretty bad. We had a lot of snow, but normally, you'll have a storm and then you'll have like 10 days of just beautiful sunny weather. And, as long as you go out and clear everything, it's fine. So anyways, you didn't come here to talk about or to listen to me blather on about, snow and the heat and all that good stuff. You came here to find out how did the markets do, what's going on in the world, and, to look at this pretty face. And there are turkeys everywhere in my yard right now. So if you've never lived anywhere with wild turkeys, they are disgusting little creatures. They poop everywhere. They kick up right now they're digging around in the dirt and the mulch in my yard and probably eating all the bugs. So anyways, all right. If it's your first time watching Liberty Call, thank you very much. If you could, give me some thumbs up, like, share, subscribes, follows, and press that notification bell if you would. So it goes ding when it's time for me to go live. So let's go ahead and jump into the numbers for today. All right. Dow Jones was up 0.25%, 87 points, closed at 34,663. S&P 500 was up 0.7%. Closed at 44.88. NASDAQ was up 1.14%, closed at 13,917. The VIX was down 0.29% today. It's currently holding at 1380. Canada was up 0.54. Brazil was up 1.36. And Mexico was down 0.44%. Over in Europe, Germany was up 0.36%. UK was up 0.25%. France was up 0.52%. Netherlands down 0.03%, so essentially flat. Spain up 0.75%, Italy up 1.03%, Switzerland up 0.22%, and Portugal up 0.42%. Russian exchanges were split today. MOEX down 0.65%, the RTSI up 2.08%. And the overnights in Asia, the Nikkei in Japan was down 0.41%, Australia up 0.5%, New Zealand down 0.59%. In China, the Shanghai was up 0.84%, the Shenzhen Component up 0.98%, China A50 up 0.67%, DJ Shanghai up 0.92%, Hang Seng down 0.57%, and the Taiwan weighted down 0.86%. So, and let's take a look at the dollar index while we're here. That is something that has been jumping around. You're probably wondering, why are things more expensive? What's going on in the world? So the dollar index right now we're sitting at 104. Let's stretch this out a bit. Let's look at this on the 5-year level. So here's where we were back. Was it right at the beginning of the whole, or 3 years ago when all the madness started? We were sitting around just under 100, 98, 99, somewhere in that range. Then the dollar fell. And looks like it bottomed out around 89.90 in, say, May of 21. And I remember at the time I was telling clients, hey, pay attention to the dollar index, because if the dollar index starts to really fall, it's going to make imported goods more and more expensive. So, and then it climbed up till, when was it, September of last year. It peaked out at about 111, and then since then has kind of been sideways after it fell through, I guess, January. So it's really kind of been sideways in this amount of time. So I know. Anyways, just something to pay attention to out there, folks, is, watch the dollar index, because we stretch it out over a longer period of time. We've had stretches of periods of time where we were down in the 70s, meaning that the other currencies were much stronger than the dollar. And then up here where the dollar was really, really strong, post, the .com bust. So anyways, all right. Not that exciting, but let me shrink that down and let's go ahead and hop into the weekly update and see what's going on there. All right. Concerns that the Fed may raise interest rates soured investor sentiment, sending stocks lower in a holiday shortened trading week. The Dow Jones Industrial Average slipped 0.75%, while the S&P 500 declined 1.29%. NASDAQ was down 1.93%, and internationals lost 1.28%. Stocks resumed their decline. Stocks were bedeviled by rising bond yields and higher oil prices last week, with technology shares bearing the brunt of the decline. Hopes that the Fed may not find it necessary to raise interest rates were dented by economic data reflecting higher prices, rising labor costs, and fewer than forecasted initial jobless claims. The inflationary implications of higher oil prices also contributed to the growing sense that the Fed may implement additional rate hikes. I've been saying that for a while, folks. While bond traders generally still expect no rate hike in September, the likelihood of a 0.25% rate hike or higher in November jumped to 43.3% by Friday morning and from 35.4% a week ago. Oil prices spiked. Last week, Saudi Arabia and Russia announced that they would extend their oil production cuts to the end of the year. Investors had expected these cuts to be stretched out to October, so the 3-month extension surprised the markets. The announcement sent oil prices higher on supply shortage worries in the coming winter months, with West Texas Intermediate oil prices price climbing to a 10-month high. Higher oil prices also sparked concerns that it would make the Fed's inflation fight more difficult, potentially forcing the Fed to hike rates above market expectations. Key data coming out this week. On Wednesday, we have the Consumer Price Index. Thursday, we have jobless claims and the Producer Price Index and retail sales. Friday, consumer sentiment and industrial production. Just one company, major company reporting earnings this week. Adobe is reporting on Thursday. All right, so that's all the excitement of the weekly update. Let's go ahead and hop into the market recap for today and see how things are going. S&P 500 rises on Tesla. Big tech rack up gains. All right. On September 11th, today, the S&P 500 experienced a boost primarily driven by a surge in Tesla and significant gains in the tech sector as investors exhibited optimism in the lead up to Apple's highly anticipated iPhone 15 launch scheduled for the following day. That'd be tomorrow, folks. Tesla surged by over 9% after Morgan Stanley upgraded the electric vehicle manufacturer from equal weight to overweight. The upgrade was motivated by optimism surrounding Tesla's supercomputer Dojo. This powerful computing system can process data collected from Tesla vehicles on the road, which is then used to train AI models for autonomous driving. Morgan Stanley analysts believe that Dojo's capabilities could accelerate the adoption of robotaxis and network services, potentially increasing Tesla's market value by as much as $500 billion. They stated that Dojo could add substantial value to Tesla through faster adoption in mobility, robotaxi services, and network services, software such as Service or SaaS. Qualcomm also stood out among chip stocks with a 4% increase in its stock price. This followed the announcement that Qualcomm had reached an agreement to supply 5G modems to Apple's iPhones through 2025. This development was particularly significant as it preceded Apple's iPhone 15's launch event scheduled for the following day. Analysts expect the iPhone 15 to drive a wave of upgrades among Apple's consumer base, with Wedbush estimating that approximately 25% of Apple's 1.2 billion installed base had not upgraded their iPhones in 4 years. Probably because they're ridiculously expensive. That's what I'd guess. This potential for a substantial upgrade cycle, along with the anticipation of new iPhone models, contributed to Qualcomm's positive performance. In the media sector, Disney and Charter Communications resolved their dispute over cable fees, allowing Charter's cable customers to access Disney-owned channels like ESPN and ABC. While the financial terms of the deal were not disclosed, Charter customers gained access to ad-supported apps Disney Plus and ESPN Plus as part of their packages. This agreement had a positive impact on media stocks, including Fox Corp, Paramount, and Warner Brothers Discovery. Lastly, J.M. Smucker announced a deal that it would acquire Hostess brands for $34.25 per share, valuing Hostess at approximately $5.6 billion. This acquisition came after competition with General Mills to acquire Hostess brands, which had returned to the public markets in 2016 after being a private company. Following the announcement, J.M. Smucker's stock price fell by 6%, while Hostess brands stock jumped by 19% to reach a new 52-week high. These market movements showcase investor reactions to significant corporate developments and their anticipation of upcoming product launches and agreements in various sectors. Whew, that was a lot of stuff for today. But it appears things are still kind of upbeat. All right, one last article here comes from First Trust, our friend Brian Westbury, his Monday morning outlook titled Our Stagflationary Future. That sounds positive, doesn't it, folks? All right. Just a month ago, many analysts and individuals believed that the significant concerns about inflation had subsided. They were wrong. This perception was based on various factors, including approximately 22 quarter point rate hikes and the most substantial drop in the M2 money supply since the Great Depression. Consumer prices had risen modestly, with July seeing a mere 0.2% increase. Furthermore, year-over-year inflation had slowed to 3.2%, significantly below the 8.3% increase witnessed in the 12 months leading up to August of 22. A period marked by Russia's invasion of Ukraine. However, this optimism is now being challenged by a reversal in oil prices, which is expected to result in a notable increase in the August Consumer Price Index. It's anticipated that the CPI will show a 0.6% rise for the month, which would translate to an annual inflation rate of approximately 3.7%. This suggests an acceleration in inflationary pressures, deviating from the Federal Reserve's stated inflation target. And that's something I'd mentioned, probably a year ago when they started raising rates. Was my fear was that they're going to crank those rates up, and at the first moment of it starting to subside, they're going to go, okay, we're done. And we'll have another situation like we had in the early 80s where, inflation went up to like 20%. They jacked up rates. They pulled them back a little bit after inflation started to ease, and then inflation went right back up and they had to do it all over again. So again, you can go back and look at the charts and see what the Fed did, to combat, to tackle the inflation at the time. But it took basically two assaults on it to really get it down below where they wanted it to get to by the end of the 80s. All right. However, this optimism, I already read that part. Moreover, alternative measures of inflation, such as supercore inflation, which excludes energy, food, and housing prices, are also signaling elevated inflationary trends. In July, this measure was up to 4.7% year over year, surpassing the 4.4% level recorded when it was introduced. The Cleveland Fed's median PCE inflation rate is also on the rise, standing at 4.8% in the past year. While some have started to downplay these measures of inflation, it's worth noting that many of these same individuals once championed them as more accurate gauges of inflation. The shift in perspective may be attributed to these measures not aligning with their desired narrative of inflationary progress. Yeah, when the charts or reports don't go the way you want or the way you've been trying to telegraph them, you sit there with egg on your face. There are historical parallels worth considering. The 1970s saw a surge in government spending during the Great Society era, leading to the monetization of the spending by policymakers. This combination of expansive government and easy money policies ultimately resulted in both slowed economic growth and elevated inflation. However, a shift in policies under Reagan and Volcker reversed these trends, driving growth while taming inflation. Some see echoes of this pattern in recent times with significant government spending in response to the 2008-2009 financial crisis and the COVID-19 pandemic, contributing to weak economic recoveries and rising inflation. While it is possible that the reduction in M2 money supply could bring inflation down to the Fed's 2% target over the next few years, there's a growing chorus of voices advocating for the Fed to raise its long-term inflation target from 2% to around 3% for now. The Fed is expected to maintain its 2% inflation goal to avoid undermining its credibility, like they ever had any. And changing this target could evoke memories of the challenges faced during the 1970s when combating inflation seemed insurmountable. In conclusion, the recent surge in inflation, driven by various factors including government spending and monetary policies, challenges the notion that inflationary concerns have dissipated. While short-term fluctuations may occur, many experts believe that achieving consistently low inflation will require a shift in policy akin to one seen in the 1980s. All right, so that's that. All right, well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful evening, and I'll talk to you next time. Adios.